Hi everyone, I hope you guys are all doing well. It's our second week now of these pre-recorded lectures. I'll be back tomorrow, the 26th, if you're watching today on Monday the 25th. But today we're going through Chapter 3, Cost Behavior Analysis and Use. So this chapter is really going to build on a lot of the concepts we discussed in Chapter 2 and kind of continue on with how we use them and how we calculate certain things. So our learning objectives are 1. Describe how fixed and variable costs behave and how to use them to predict costs. We've already kind of touched on our fixed and variable costs in the last chapter. Analyze mixed costs using various approaches. 3. Prepare an income statement using the contribution format, so just a different way to prepare an income statement to better serve the managerial accounting perspective. And 4, so this one's a bit of a different one. It's not really a testable item. It's more just about an information point, but it is analyze a mixed cost using a least squares regression method. So we won't super touch on that. If you really are interested, you can go follow the appendix, but we'll briefly touch on it at the end of the chapter. So type of cost behavior pattern. So you'll recall the summary of our cost behavior discussion from chapter 2. So the two costs we talked about were variable and fixed costs, and we look at the behaviors of these costs in two different ranges, or within the relevant range, but in two different ways. So we can look at them by their total cost and by their cost per unit. So for variable costs, our total cost, our total variable cost changes as the activity level changes, if you remember. And on a variable cost per unit basis, it remains the same over a wide range of activity. So remember, this wide range of activity is just within this relevant range. On the other hand, our fixed cost, so our total fixed cost, remains the same even when our activity level changes. So no matter how many of something we're using or making, our total fixed cost will stay the same. But on a per unit basis, the average fixed cost per unit goes down as the activity level goes up. So to refresh again, our activity base is a measure of what causes the incurrence of a variable cost. That can be all kinds of different things like units produced, machine hours, miles driven, and labor hours. And so what you can think about this is so what's causing the incurrence of a cost. So a good example of this is think of a taxi driver. So what is causing the cost on the taxi driver? So what costs would they have? Well, they'd have obviously gas costs. They would have wear and tear in their vehicle, any maintenance they had to do in the vehicle, things like that. So what is driving that? Well, one thing you could do is, you could divide the cost between the number of drives you make, but every drive is going to be a little longer or shorter, will have a different impact on the gas you used up or in the wear and tear in your vehicle, so that doesn't make the most sense. So really what is driving that cost for a taxi driver is the kilometers they've driven, because the more kilometers they drive, more gas they have to pay for, the more their car is being used. So that would be a good activity base for them. And so some activity bases work better for certain activities, like I said. So for a taxi driver, the kilometers driven makes the most sense. But in every kind of company or every kind of service or product you're selling, they'll all have different activity bases that are the most accurate way to track and allocate your costs. So we have our variable cost example. So a variable cost is a cost whose total dollar amount varies in direct proportion to changes in the activity level. So for example, again, your total long distance telephone bill is based on how many minutes you talk. So we can see this graph, the more minutes we talk, the more this goes up, the bigger the increase in our total cost. For every activity, for every change, our total cost for a variable cost will go up based on that activity. On the other hand, the variable cost per unit, so a variable cost remains constant if expressed on a per unit basis. So the cost per minute talked is constant. So for example, say it's always going to cost 10 cents per minute we talk. So it doesn't matter how many minutes we talk, we're still going to be charged 10 cents per text. So the cost per unit will stay constant for variable costs. So the extent of variable cost, the proportion of variable cost differs across organizations. So every different kind of organization will have a different spread of variable cost. So for example, a public utility with large investments in equipment will tend to have fewer variable costs. A service company will normally have a high proportion of variable costs. A merchandising company will usually have a high proportion of variable costs, like cost of sales. So again, you're incurring costs as you sell them on a per unit basis. So same with the service company. As you are giving out services, you're allocating out those costs. And a manufacturing company will often have many variable costs as well. So you can see variable costs will be higher in companies where the unit, the activity level is kind of a big variance, where a public utility, so think of Nova Scotia Power, everyone's going to be using it. It's been pretty consistent. They make big, large investments in order to fulfill that demand, so they're going to have a lot less variable costs. So examples of variable costs, we look at the type of organization and the costs that are normally variable with respect to the volume of output or units sold or produced. So for a merchandising company, the big one will be cost of goods sold. So we will only be incurring our cost of goods sold once we actually make a sale. So remember our flow charts from before. In a merchandising company, you're buying finished goods and putting it right into your inventory, and they're going to sit on the balance sheet and inventory until a sale is made. And then once the sale is made, the cost of that inventory is expensed out. So if you're not selling things, the expenses are not being incurred. For a manufacturing company, so the things that will be variable is largely based on what we're producing and how much we're producing. So the things that go into production are our manufacturing costs, and these variable ones include our direct materials. So again, the materials that are directly used to make a certain product. We can also look at our variable portion of manufacturing overhead. So these would include our indirect materials such as lubricants or supplies. So again, those will change based on how many products we're making. We can also look at power. So this is kind of a different one, but power would be variable because, well, if our factory that we're using to produce wooden benches isn't working or operating, or it's working in overdrive, well, our power bill will depend on how much we're actually using during the month. So some variable costs that will be the same between both merchandising and manufacturing companies would be our selling general administrative costs. So examples of those are our sales commissions. So think if we're not selling anything, the sales staff isn't making commissions on sales. We have our clerical costs such as billing. So again, if a company was really booming and making a lot of sales, well, on the other side of that, you have to process that accounting information. You might have to hire more accounts receivables clerks. So that will vary depending on how much they actually have to process. Shipping costs, same idea. If we're not selling, we're not shipping, we're not incurring those costs. But if we're super, super busy, then we're going to be shipping a ton and that cost will end up going up. And then lastly, for service organizations, some variable costs will be supplies. So say your service you provide is painting nails. So if you're doing your nail polish, your buffs, all that kind of stuff to paint the nails, that'll depend by how many clients you have. Same idea with travel. If you're not going out on jobs, you're not traveling. Clerical is the same way. The more service jobs you're getting, the more processing you have to do. And same thing with sales commission. So we can look at the idea of a true variable cost. So an example of a true variable cost is direct materials. And that means direct materials is a true or proportionally variable cost because the amount used during a period will vary in direct proportion to the level of production activity. So again, back to my favorite example of the wooden benches. Every time we make new products in this bench, so again, if we need 4 4x4s to make the bench, it's going to go up by every time we're going to incur a cost of another 4 pieces of wood for every product we make. It's going to be completely equal. Every product is going to incur the exact same amount of cost each time we increase the activity level. So there's true variable cost, but on the other hand, on the next slide, we'll learn about something a little different. So this other variable cost type is a step variable cost. And this is a resource that is obtainable only in large chunks, such as a maintenance worker, and whose costs increase or decrease only in response to a fairly wide change in activity, is known as a step variable cost. So to use that example of a maintenance worker, think of that. So say in your company, you have enough, at the end of the day, you need one janitor. By the time they're done their, say, their 5-hour shift, they'll be able to clean the entire factory. But then think, flash forward a year, you've doubled production, you have a bigger space, you have more workers, you have more machines going and making waste and getting dirty throughout the day. So at a certain point, the maintenance worker is able to just, work a little harder, do a little more, clean more, have less downtime. But at a certain threshold, that one maintenance worker isn't going to be able to do the job anymore. And at that point, at that step, you're going to have to hire another maintenance worker. So you can see from this graph, so this is us with one maintenance worker. So between this area and this area, we're able to get by with the cost of this one maintenance worker. They're able to do all of that work. But once we hit this volume, we have to incur another cost to get another maintenance worker because the volume has gotten too high for that one person to handle the load anymore. So this is what we mean by a step cost. It'll go up in steps as opposed to directly proportional for every unit. So to get this new maintenance worker, it wouldn't necessarily be if we produce one product and then two products. It might be every 10,000 products that waste generates, we require another maintenance worker to cover that load. So to reiterate that, small changes in the level of production are not likely to have any effect on the number of maintenance workers employed. So like I said, between this volume and this volume, we don't need another maintenance worker. They're able to do it. It's a small enough change in volume that they're able to handle the additional load without any extra cost that we have to incur. So only fairly wide changes in the activity level will cause a change in the number of maintenance workers employed. So again, once we hit that threshold at this volume level right here, we're going to have to jump up our cost, hire another worker, who then will have their own plateau volume until we have to hire another one. So that's what we mean by step variable cost, because it makes a cute, nice little staircase here. And they increase over a much wider change in activity level than a true directly proportional cost. So we have this linearity assumption and the relevant range. So this function here, so we have activity on the bottom here and total cost here. So from an economics point of view, they feel the costs, or they know the cost function kind of in this curved line. So it's not directly proportional. You have variable costs, you have step costs. So this is the general line at which costs will function. But from an accountant's point of view, we like to use our accountant's straight line approximations. We have a constant unit variable cost. So I think again, of our true variable costs, that for every product or activity we incur, our cost is going to go up in a straight proportional fashion. So the way we can get away with this is that a straight line closely approximates a curvilinear variable cost line within a certain relevant range. So this is the relevant range we've been talking about. Is that, well, if we look at this line here, for example, in this relevant range, so if we cut it here and here, well, it is focusing as a straight line. And so our assumptions within this range are going to be true if we're assuming this variable cost is going to have a proportional increase based on activity within this range. Now, if we were looking at a range outside of here, so say we were looking at the range from here to here, well, this line's not straight, and so all of our assumptions may not be correct based on the direct proportional theory we have. So whenever we're talking about this relevant range right here, we're talking about this straight line. And that's all you really have to know about that. So now we can jump back into our total fixed costs. So if you remember, a fixed cost is a cost whose total dollar amount remains constant as the activity level changes. And our example was your monthly basic telephone bill is probably fixed and does not change when you make more local calls. So again, that's your unlimited call and text plan. So it doesn't matter how many calls or texts you make, you're still going to pay that $100 per month for your phone bill. It's completely fixed at the total cost level. On the other hand, for our fixed cost per unit, so the average fixed cost per unit decreases as the activity level increases. So again, the fixed cost per local call decreases as more local calls are made. So like we said, if we're paying $100 per month and we make one call, well, that one call, it was costed to us for $100. But if we end up making 4 calls, then each call at a cost per unit basis is worth $25. So the more activity we have for a fixed cost, the cost per unit is going to go down. So we have two different types of fixed costs to look at. The first being our committed fixed costs. So these costs are long-term and they cannot be significantly reduced in the short term. So examples of these are depreciation on equipment and real estate taxes. So if you think about that, we incur depreciation. So when we buy a capital asset such as a new factory machine, instead of expensing it when we buy it, we will depreciate it over its useful life. So say we bought this factory equipment for $5,000. It has a useful life of 5 years. So every year we're going to incur a depreciation expense of $1,000 until the end of its useful life, and at which point it is no longer worth anything. So to be able to change that's kind of hard because, well, that is the depreciation life cycle for our equipment. We can't really change that $1,000 every year. That's what's going to have to happen. Same thing with real estate taxes. You have to pay a certain amount on your property taxes. It's assessed by someone else. You can't quickly change that cost because it's kind of an external cost to you. But then we have our discretionary fixed costs, and this is the complete opposite. So these costs may be altered in the short term by current managerial decisions. So an example of this is advertising. So if you're running an advertising campaign, well, while this may be fixed, so say you're paying $1,000 for this campaign to go, or every year it's $1,000 to go toward it. Well, you could in the short term just cancel that plan. We're going to fire the marketing staff or stop the marketing plan, and we're going to recoup that $1,000. Same thing with research and development. So if we're researching a new product, it's incurring a bunch of costs every year to have a facility open doing it. Well, in the short term, we can cancel that facility, stop research, and stop incurring those costs, or those fixed costs in the short term. So that's the big difference. Committed fixed costs, we have no power over changing the cost until the long term, but for discretionary fixed costs, we can change them with our managerial decisions in the fairly short term. So the current trend in many industries is toward greater fixed costs relative to variable costs. And we can see this as machines take over many of the mundane tasks previously performed by humans. So think on an assembly line, instead of having someone putting together toys or putting together anything, there's now machines that are able to do that efficiently and more effectively and faster and at less of a cost to us. Knowledge workers are demanded for their minds rather than their physical muscles. So again, think of an accountant versus a laborer. The accountant is a knowledge worker because we're offering a certain expertise in accounting as opposed to physically performing a task. So knowledge workers tend to be salaried, they're highly trained, and they're more difficult to replace because of the level of training and schooling it may require to become a knowledge worker. The cost to compensate these valued employees is relatively fixed rather than variable. So as we can see again, for fixed costs in the relevant range, total cost doesn't change for a wide range of activity and then jumps to a new higher cost for the next higher range of activity. So looking at this example of rent, so we have our rent cost in thousands of dollars and then our rented area. So based on this graph, it's $30,000 for us to rent for 1,000 square footage. And so anywhere between this, if we had 800, 700, 600, it's still going to cost us $30,000. But after this $1,000, we're going to have to jump up and pay $60,000 for anywhere between this $1,000 to $2,000 range. So you can see this jump between them is much larger than when we look at our variable costs. So the relevant range of activity for a fixed cost is the range of activity over which the graph of the cost is flat, as we saw in the graph in the past slide. As the example said, the office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. As the business grows, more space is rented, increasing the total cost. So how does this type of fixed cost differ from a step variable cost? Well, a step variable cost can be adjusted a lot more quickly, and the width of that activity step, so those between each cost jump, is much wider for a fixed cost than for a variable cost. So a quick check here. Which of the following statements about cost behaviors are true? So 1, our fixed costs per unit vary with the level of activity. So the key word here is our cost per unit for our fixed costs. So as we know, our fixed cost per unit will vary with activity. So this is right. And think of our phone bill example. If we're paying $100 per month, Well, the cost per unit of that fixed cost will vary depending on how many calls we make during the month. So if we make one call, it's $100 is our cost per unit. If we make two, it'll be 50, and so on and so forth. Our next one, our variable costs per unit are constant within the relevant range. So our variable cost per unit, this is also true. So think again of our variable cost. So say it's 5 cents per text. It doesn't matter how many texts we send, it's still going to be 5 cents for every text we send. So think of this graph where we had the line, so our cost per unit for our variable cost will stay consistent. Next, our total fixed costs are constant within the relevant range. So our total fixed cost, yes, this is true. They will remain constant within the relevant range. Even though up above, our cost per unit for a fixed cost will vary, the total cost will stay the same. So you'll still be paying that $100 every month. So that one is also right. And lastly, our total variable costs are constant within the relevant range. So our total variable costs, this is not true. So remember, our total variable costs vary with the activity level. So for every other unit we're producing or selling or whatever it is, our total variable cost will increase. So another kind of cost we can look at that has a bit of a different behavior is a mixed cost. So a mixed cost is when a mixed cost has both a fixed and a variable component. So it's two components. And consider the example of the utility cost below. So as we can see, this is a power utility. So we have our activity on the bottom and our total cost up above. So say for this utility, there is a fixed monthly utility charge. And let's say it's $200. So every month, no matter how much kilowatts you use of power during the month, whether it's 0 or a million, you're still going to pay $200. So that's here. This is our first cost line. But as well, there is a variable portion because for every kilowatt we use, maybe it costs an additional $2 per kilowatt used. So we're going to have two components of this mixed cost. There's the variable component, will vary by the kilowatts we used, and there's a fixed monthly charge that won't change at all based on how whatever we use during that month. So we can express this function as an equation, and our equation, the total mixed cost line can be expressed as this equation, which is y equals a plus b times x. And so you can see our y is our total mixed cost, a is the total fixed cost, the vertical intercept of the line, b is our variable cost per unit of the activity, which is the slope of our line, and x is the level of activity, which in this example was kilowatts used. So let's do an example together. So if our fixed monthly utility charge is $40, our variable cost per unit is 30 cents or 3 cents per kilowatt hour, and your monthly activity level is 2,000 kilowatt hours, what is the amount of our utility bill? Let's take a look at our formula. So our formula, remember, is y equals a plus b times x. Our a is our fixed cost, and in this case, our fixed monthly utility charge was $40. Our b is our variable cost per unit, so we can see our unit in this case are these kilowatt hours, and it's going to cost us 3 cents per kilowatt hour, so there's our 3 cents right here. And our activity level, which is our kilowatt hours, is 2,000. So if we add, first we multiply these together and add 40, we're going to get $100 as our total mixed cost for this month. So to analyze our mixed costs, the fixed portion, so in that case we just went over our fixed utility cost, the fixed portion of this mixed cost represents the basic minimum cost of having an activity ready and available for use. So like they said, they want to charge us $40 to provide us power in any capacity to have it ready and hooked up and ready to go. The variable portion represents the cost incurred for actual consumption of the activity. So like we said, for every kilowatt we actually use, it's going to be an additional 3 cents every time. So some common methods used for estimating the fixed and variable components of a mixed cost are account analyses, engineering approaches, the high-low method, and the regression analysis. So using an account analysis, each account is classified as either variable or fixed based on the analyst's knowledge of how the account behaves. So think of it as if we were looking at our cost of goods sold account, well, we're going to know that account is going to be mostly variable because the more we sell products, the more cost of goods sold we're going to incur. On the other hand, if we were looking at our insurance account, our insurance expense, well, usually insurance policies are sold on kind of an annual basis, so we realize that's probably going to be a fixed cost just based on the account it's in. Another approach is the engineering approach, which cost estimates are based on an evaluation of production methods and material, labor, and overhead requirements. So an engineer in that case would have more expertise to kind of determine based on what they're doing, how the costs are going to function for their specific processes. So we can also use a scatter graph plot in order to figure out some information about our total cost versus activity data. So the first step in this slide, so you can see on our axes we have the patient days in thousands, and on this side we have the total maintenance cost in thousands. So your first step is to get your data points and plot them on your graph. So obviously for the first one was 1,000 patient days for say 11,000 maintenance dollars and so forth. So you plot all your dots based on the information you have onto your graph, and then using this we can go to the next slide, and our next step is to draw a line through these data points with about an equal number of points above and below the line. So this is our next step. We draw a line through, try and get as many above and below as we can to make it fairly even. And so when we've done this, we can make some pretty basic assumptions. So we can use one data point to estimate the total level of activity and the total cost. So for example, if we look here, the total maintenance cost is going to be where the line intercepts here. So we can see at 800 patient days, which is right here on our plot, and if we go up to the line and go over to where it connects, is $11,000 of maintenance cost. So from that we found out our total maintenance cost is $11,000 for this line, this point we picked hits this side of the cost, and we also figured out our total patient days was 800 for where it hits right here between the 0 and the 1, and this is in thousands, so that's our 800. And we can also glean the information that, well, when our activity is 0 and or our patient days is 0, our activity driver is 0, and we still have a cost of $10,000, well, that must mean that our fixed cost, where this line intercepts this y-axis, must be our fixed cost. So to recap, we now know our total maintenance cost is $11,000. We know that our fixed cost portion is $10,000, and we know our activity level at this point was 800 patient days. So now using this information, we can make a quick estimate of the variable cost per unit and determine our cost equation for this line we just made. So as we said, we know the total maintenance cost at 800 patients was $11,000. We're going to take away our fixed cost of $10,000, and we know everything that's remaining, so this $1,000 that remains must be the total variable cost at 800 patients, because we took away from our total cost where it's a mixed cost, so it has both the fixed and variable portion. If we take away our total fixed cost at that point, this remaining $1,000 is our total variable cost. So if we take it the next step over, if we can find our variable cost per unit, so if we know our total variable cost is $1,000 and we know our activity level is 800, we can deduce that our variable cost per unit is going to be $1.25 per patient day. So that's our 1,000 divided by 800. So now we have our variable cost per unit. Now we can stick together our formula we learned, if you remember, which was our Y, our mixed cost, equals our A, fixed cost, plus our B, the variable cost per unit, times our activity level. So you can see next, our formula is this 10,000, which is our fixed cost, plus our $1.25 per patient day, our variable cost per unit, times whatever number of patient days. So now using this formula, we can figure out any other the total mixed cost, the total maintenance cost at any other activity level along that line. So yet another method for finding these costs is the high-low method. So the high-low method is based on the rise over run formula for the slope of a straight line. If the relationship between cost and activity can be represented by a straight line, which as we know from previous slides in the relevant range we are assuming it is a straight line, then the slope of the straight line is equal to the variable cost per unit of activity. So to analyze the mixed cost, you need to identify the period with lower level of activity and the period with the highest level of activity. So our variable cost is going to equal our change in cost and our change in activity. So let's look at an example of this high-low method. So assume the following hours of maintenance work and the total maintenance cost for 6 months. So as we can see, for the month of January, we had 625 hours of maintenance and the total maintenance cost of $7,950. In February, we had 500 hours with the total cost of $7,400. In March, we had 700 maintenance hours at a total cost of $8,275. In April, we had hours of maintenance of 550 with a total cost of 7,625. In May, our total hours were 775 with a total cost of 9,100. And in June, our total hours of maintenance were 800 with a total cost of 9,800. So what we want to do in the high-low method is identify our lowest level and our highest level. So you can see they already kind of pulled it out for us. So out of these, all these numbers, our lowest level was February. So we had 500 hours of maintenance for its 7,400 total cost. You can see here our low level. And our highest month was in June. So in June, we had hours of maintenance of 800 with a total cost of 9,800. So that is our first step. We identified our highest level and our lowest level. And then now we're going to look at the change between them. So if we look at our high level and our low level for hours of maintenance, so our high level had 800, our lowest level had 500. So the change between them is 300 hours. And then if we look at our total maintenance cost, our highest level had $9,800 and our lowest level had $7,400 for a change of $2,400 total. So the variable cost per hour of maintenance is going to be equal to the change in our cost, so this $2,400, divided by the change in our hours. So our $2,400 right here divided by our change in hours of 300, which is right here. So we can figure out our variable cost per hour is $8 per hour. Alright, so for the next step, we can use this high-low method, so the information we learned. So in the last slide, we learned that our variable cost per unit, this is important to remember, is going to be $8 per hour. So we already know our variable cost per unit. So let's look at our formula. So we can rearrange it. So normally, looking at this, we have our total cost is going to equal our total fixed cost plus our total variable cost. Remember, our total variable cost is our cost per unit times the number of units. So we rearrange it now because we're looking for our total fixed cost. So in order to get total fixed cost, we're going to have to use our total cost minus our total variable cost. And so how you do this is because we know our cost per unit, we figured that out in the last slide. We're going to use the information we have from one of our data points to use as the other parts of the formula. So we're just going to solve for this total fixed cost. So for this example, I'm going to use the high level. So we had 800 hours of maintenance and our total maintenance cost of 9,800. So if we fill it in, our total fixed cost is going to be our total cost, 9,800, minus our total variable cost, which we can calculate by our $8 per hour is our cost per unit for our variable costs, times the number of units, which is our 800 hours of maintenance. So if we do those first, $8 per hour times 800 hours is 6,400. If we take it away from our total cost of 9,800, our total fixed cost is going to be $3,400. So that's the great thing about these formulas, is that you can mix and match them around to, as long as you have the other variables, you can solve for the one that you're missing. So now that we found all the pieces of our formula, we can make our cost equation for this maintenance, which is our total cost, our total maintenance cost is going to equal our fixed cost of 3,400, which we just figured out in the last slide, plus our variable cost per unit of $8 times whatever units we want to look at. So now we can recalculate it based on 500, 400, 200. We can use this cost equation to figure out what the total cost will be at any point. So let's do a quick check on this. So in this example, our sales salaries and commissions are $10,000 when 80,000 units are sold and $14,000 when 120,000 units are sold. So using our high-low method, so that's important to know what method we're going to be using, our high-low method, what is the variable portion of the sales, salaries, and commission? So if you remember, we're going to have to get our high and low data points. So for our high points, it is going to be our $14,000 in cost. So our cost is going to be this 14. Might be easier here to see. So our high low is the 14,000 with 120,000 units sold, and our lower range is going to be $10,000 with 80,000 units sold. So in order to figure this out, we're going to take our high level of units, so the 120,000 we point out, and our low level, and we're going to subtract the low from the high, so 120,000 minus 80,000 is going to give us 40,000. We're going to do the same thing with the cost, so our high cost was the $14,000 minus our low level cost of $10,000 to give 4,000, and then we're going to divide the total cost, the total change in the cost of $4,000 by our number of units, our 40,000 units, to get a cost per unit of 10 cents per unit. So this is going to represent the variable portion of our sales, salaries, and commissions. So our next one is our sales, salaries, and commissions are 10,000 when 80,000 units are sold and 14,000 when 120,000 units are sold. So same as our last problem. Using the high-low method, so again, we're using this high-low method. What is the fixed portion of sales and salary commissions? So we can do this by rearranging our formula. So our total cost is equal to our total fixed cost and total variable cost. In this case, if we want to use our high data point again, so if we look at our total cost being this 14,000, we're looking for our total fixed cost, and we know from the last slide that our cost per unit was this 10 cents. We're going to use the $120,000 units from this data point, which comes in here. So we can rearrange our formula to be our total fixed cost is going to equal our 14,000, which came down from there, and minus our 12,000, which represents our 10 cents times 120,000 units. And if we subtract those two, our total fixed cost is going to be this $2,000. So we could talk a little bit about this least squares regression method. So the two methods we just discussed, so the scatter plot graph where we drew the line in between all the points, and then the high-low method where we use the highest and lowest values to estimate the fixed and variable cost of the mixed cost, they're going to give us different estimates. And the reason being is because each of these methods uses different amount of data points to provide the estimate. So for the scatter plot, remember, we mapped a bunch of different points in the graph, and there's probably 8 of them in the example that we saw to get our line, and that line is what we use to estimate our costs. And for the high-low method, we're actually only using 2 data points. We're using the lowest and the highest, and assuming the whole line shape just between them. So we're bound to get some slight differences in our estimates based on that. So if you want it to be more accurate, there is another method called the least squares regression, which provides the most accurate estimate because it uses every data point available. This is more of a mathematical model. It's easier to use for like a computer software or something like that. It's discussed more in the appendix to the chapter. I mentioned it in the learning objectives. This is not going to be something I'm going to test you on, but it's just good to be aware that there is some downfalls of the methods we use by hand because they're simpler and easier to do, and there is some better models like the least squares regression method, which are a bit more complicated but will give you more accurate data. So our last learning objective for this chapter is the contribution format for the income statement. So why do we need a new income statement format? The traditional format income statement is organized by function, and fixed and variable costs are not distinguished. So we separate these costs into fixed and variable elements is often crucial in decision making for managers in the managerial accounting perspective. And it helps us facilitate planning, control, and decision making. So on our next slide, we'll show an example of what a contribution format income statement looks like. So as you can see, our contribution format will break out the variable costs and our fixed costs. If we go from the bottom to the top, we're going to start as normal with our sales revenue of $100,000, but then we're going to take away our variable costs of $60,000 to get our contribution margin. So our contribution margin is our sales revenue less our variable costs is our $40,000 contribution margin. So the contribution margin format emphasizes cost behavior. So our contribution margin covers our fixed costs and provides for income. So these fixed costs down here, these $30,000, as we know, they're not really going to change. They're pretty fixed. So why we care about our contribution margin and knowing our variable cost is, well, the more things we sell, the more revenue we're going to make and the more costs we're going to incur. And our contribution margin, especially when you look at it on a per unit basis, so we can see, so say this is us selling our wooden benches, for every bench I sell, I'm going to make $20. So that is my revenue per unit of $50, my cost per unit of $30, so my contribution margin, my kind of net income on this is $20. So I know if I want to plan my production, well, I'm trying to cover my $30,000 in fixed costs at least just to break even. And break even just means that I'm covering all of my fixed costs. I'm not making any profit yet. I just am breaking even and not losing my own money. So I know, well, if I'm looking to make money, I'm going to have to at least break even. So let's say I have 30,000 fixed costs, and I'm going to divide it by 20 per unit. Well, I know I have to sell at least 1,500 units to break even. So that means I'm going to want to sell more than 1,500 units to make a profit. So this is why this is very useful for managers to see what they're currently selling, what their aim should be, and how they're going to get there. So maybe that means changing their marketing strategy to increase sales to a certain point that you know you're going to make good income. So the uses of the contribution format for our income statement, it's used as an internal planning and decision-making tool, like I just said. And in some of the later chapters, we'll look at some of the approaches that can be used using this information, including our cost, volume, profit analysis, budgeting, pricing, use of scarce resources, and our make or buy analysis. So all of these we'll look over in the coming chapters. So we can compare our contribution income statements with the traditional income statement, as you can see. So the traditional approach, the costs are organized by their functions. We have our sales is going to be $100,000 less our cost of goods sold. So the type is our gross margin of $30,000 less our operating expenses, $20,000 to get our net operating income. Or on the other hand, our contribution approach, where we organize it by the behavior, so variable and fixed. We have our sales minus our variable expenses, so we can see that some of these are different. Is our contribution margin of $40,000, less our fixed expenses of $30,000, but we still have the same net operating income. So we're just breaking out our expenses differently for different uses. So the traditional approach is primarily used for external reporting, so your normal financial statements, but the contribution approach would primarily be used by management in order to make better decisions regarding their costs. So it's time to summarize the chapter. There are three major classifications of costs, which is our variable, fixed, and mixed. Mixed costs are a combination of variable and fixed elements and can be expressed in the equation form as y, which is our mixed cost, equals a plus bx, where y is the cost, a is the fixed cost element, b is the variable cost per unit of activity, and x is the activity level. The first step in analyzing a mixed cost is to prepare a scatter graph. Costs are plotted on the vertical axis and activity levels on the horizontal axis of the scatter graph. The high-low method estimates the variable and fixed cost components by analyzing the change in the cost between the high and low levels of activity. The contribution format income statement classify costs by cost behavior, i.e. variable versus fixed, rather than by functional areas such as production, administration, and sales. So that is where I'm going to end the lecture for chapter 3. There is more content in appendix 3a about that least squares regression calculations. Please feel free to review these in the slides and the book if you're curious about them or want to learn more, but these will not be tested in a testing format, so don't worry about that as far as that. There will be a separate video just like last time where I'm going to go through a few of the practice problems. I hope everyone had a great day, and I will talk to you guys next class. Thanks, guys.